Hi, this is Phil Greenwood, University of Wisconsin-Madison School of Business, and we want to talk now briefly about the timing of financing. I don't think it's a subject that gets a lot of play or discussion when we're talking about seeking money for a business. But the timing is really when do you go out and seek money, and what type of investor will invest in that stage of your business and such. Always think of, and this, by the way, is a graphic from the New Venture Creation book by Jeffrey Timmons and Stephen Spinelli of Babson. Always think of the important thing of raising money, looking at that x-axis, the time in months to out of cash, and on the y-axis or on the vertical axis, the relative bargaining power of the entrepreneur against the various sources of capital. And as you can see, when you run out of cash or very close to it, you have very little power. Or if you go to the far right, if you have upwards of 12 months or longer of cash on hand, your bargaining power in dealing with financiers is always incredible. So the earlier you can get at it, and the more time you have, the more cash you have on hand, of course, the entrepreneur has greater deal of power in negotiation. What we like to push in our entrepreneurial management and our entrepreneurial finance class is a layered strategy. And I'll just briefly talk about this here. And we're going to discuss in greater detail each of the layers. But what we really try to encourage entrepreneurs is don't just go out and seek only one kind of financing. Don't just go for bank or only go for research grants or only for venture capital equity financing. But try to look at it in going for layers, different sources of financing. Starting with the first layer, which is, hey, if you can avoid financing through sweat equity or bootstrapping, do it. If not, try to seek grants, research grants, and so on. And you can see up through layer 2, supplier and credit financing through receivables and payables. Layer 3, bank credit through your traditional lines of credit to secure term loans, all the way up through asset bank loans, unsecured debt. Layer 5 being junior debt, unsecured, and then any convertible debt, all the way up to common stock in number 7. And what we try to encourage here to entrepreneurs is seek the different sources. Don't just use one or maybe a combination of the 7. Realizing that each level of financing is commensurate with a certain level of risk in your business and in the investment, and also a certain level of return. Of course, the higher the risk, the higher return. So in areas like common stock and such, you'll notice that'll be the highest risk financing, and they'll want the highest annual rate of return. Now, bootstrapping, we love to push, if we can, for entrepreneurs to try to do as many things creatively without seeking external financing. We like to confirm bootstrapping or define it as using any technique available for getting by on a few resources as possible. There's pluses and minuses to it. But remember that when you go to seek money and don't follow the bootstrapping route, you have a couple things you have to be very cautious of, or caveats or limitations. Remember that investors have different risk and reward profiles. Certain family members may not care. They may look upon it as a donation, whereas other investors may be very, very cautious and want a big return on their money. A second thing you've got to look for when you are contemplating seeking money is what happens if I don't get enough money, if I don't raise enough. In other words, I'm underfunding. Looking back to that original chart, the quicker I run out of money, of course, the lower my negotiation power is, and I'm at the whim of the investor. Also realize that when you seek money, there's typically, especially in the form of equity financing through private placement memorandums or business plans, there's going to be a relatively high level of legal expenses. You're going to have to pay your lawyers and the time it's going to take. It's not unusual, especially when seeking large amounts of equity financing, for it to take 6, 9 months, or even a year, depending on the economic conditions. And remember that if you decide to go the route, you just have an aversion to debt, having to pay interest and then paying back principal. If you seek the equity financing, going the family and friends route is going to be much easier than trying to go the route of professional angels, sophisticated investors, or venture